All right, let's go way back. Here are a few terms that we haven't uttered in a long time, right? ZIRP and NIRP. And what's that, right? Well, ZIRP stands for zero interest rate policy, and NIRP, negative interest rate policy. Now, I thought we were done with those, but the Swiss National Bank has brought them back into vogue, right? This week, the Swiss National Bank became the first to show that the world of higher rates may be over, and ZIRP, 0% interest rates, is coming back after the central bank cut its rate from 0.25%, 25 basis points, down to 0% for the first time since 2022. Now, it gets better. It's not just ZIRP, right? Now, NIRP is back. What's that, right? That's negative interest rate policy. And it's also here courtesy of the Swiss, because while the SNB may have cut rates to zero, the way it penalizes banks' excess reserves, holdings that they have on their books, means lenders will face negative rates if they park too much cash at the central bank. So starting today, negative funding costs for banks are therefore likely, as board member Petra Schuden told reporters in Zurich. Well, my next guest will have something to say about this, I'm sure. Please welcome to the show Mr. Luke Lloyd. Luke, I've been around, and I remember those policies, especially the NIRP, negative interest rates, because at one point in time, I think it was close to $20 trillion in bonds were priced at a negative interest rate around the world. And that's hard for people to get their head around, but it's true. And now we might be dipping our toe back in. What say you?
Yeah, it was 2020 during COVID. We saw Germany and a lot of these other countries go completely negative with interest rates. And it's very interesting, the whole concept of NIRP or negative interest rates, because literally that kind of means if you actually apply it to the overall country and economy, that you literally have to pay the bank to store your money, or the bank will pay you to take out a mortgage or something like that, if assuming everything was negative. I know that's an extreme stretch, but it's a crazy concept because it's just another way to stimulate the economy. If you can't save money in a bank and you have to pay to save that money, what are you going to do? You're going to go spend that money, right? So that helps to fuel the economy. If you basically get free money to go buy whatever you want and get paid to borrow money, essentially, that allows you to spend more money in the economy. So it's just another thing that we talk about, this debt Ponzi scheme. And what's very interesting, I'm kind of in the camp that in my lifetime, it's very possible the United States could go down to negative interest rates, or again, obviously 0% interest rates to keep the Ponzi scheme alive. So I don't think that's completely out of the question, because again, this whole world is fueled by debt. And what happens when anything cracks? They just keep on bailing things out. So I don't think that's as crazy as people might think.
It's interesting because it's now I'm reminding myself about that era and how crazy it was and how stupid it was. Now, Ireland took advantage of it. They floated a 100-year bond and for 1%, and they got it all, right? So they were able to borrow for 100 years at 1%, which looked pretty good. It still looks pretty good, actually. But another thing is that, when you say, and rightfully so, if you're penalized to keep your money in the bank with negative interest rates, you're going to take it out and probably spend it. That's the whole idea of negative interest rates, is to give that economy a boost, or even 0% too as well. But if a lot of people aren't going to want to put their money in a bank and have them lose money on it, they may maybe put it in their mattresses. But, I remember doing research on this whole deal. And do you know that the consumer is so untrustworthy and suspicious of negative rates, it doesn't actually do what the banks thinks it's going to do, because they're like, this is crazy. I'm not spending any money. What's going on? It doesn't really boost the economy.
It probably scares people, right?
Yes.
When people are scared, they don't want to go out and spend money. They want to start packing it away even more. So that makes sense. But what's also interesting, let's say a crazy example, let's say it does somehow happen here in America at some point in our future, whether it's 20, 30, 40, 50, 100 years in the future. If that were to ever happen, you have to remember who's got all the money, who's storing all the money in the bank accounts. It's not middle class America that has a couple $1,000 in their maybe emergency fund with $10,000 in credit card debt. It's the rich and wealthy. It's the top 1%. So it actually would negatively probably impact the rich and wealthy, and actually reset some of the things in the world with this whole wealth transfer going to the top. And who's caused the wealth transfer in the first place? It's the government policies and borrowing of money, and the Federal Reserve System in the first place allowed the rich to get extremely rich, because all that the government printing of money does, and all that the lowering of interest rates or hiking of interest rate does, is funnel more money to the wealthy. So again, this is where the government will come in, try to fix things. The Federal Reserve will try to fix things. Right now, here in America, the Federal Reserve's late to the game, cutting interest rates. There, in my opinion, I'll go as far as say the Federal Reserve here in America is too arrogant and too disconnected to actually understand what's happening. They are the accounting nerds, black and white, data oriented, and they don't actually go out to Main Street and talk to people to understand what is actually going on around the world. So they're going to screw things up once again. 5 or 10 years down the road, we're going to look back and say, wow, Jerome Powell and the current administration really messed things up on the way up, hiking up and cutting down.
Yeah, I mean, we just had Mike Lee on, you know who Mike is, and he's echoing your sentiments, by the way. Yeah, so he said the same thing. And, what I wanted to really quick, we've got a couple minutes left, is I wanted to highlight the fact that, the damage that negative interest rates does to all the assumptions that we've got out there. Just think of those pension funds that are assuming 5, 6, 7% compounded growth over the next 25 years. Even 1 year at negative rates throws a wrench into those assumptions big time. I mean, it's terribly damaging if we start managing money like on a zero or even negative interest rate base. So that hurts a lot. And a lot of folks, again, like I said, they don't trust it because they don't understand putting your money in the bank and getting less back.
Well, at the same point in time, what happens to asset prices? So if, let's say, the world is heading to there at one point down the road and America gets there, all that happens is asset prices go up in some sort of way. Even if it doesn't work, no one's going to invest money in the bank, or they're not going to buy treasuries at 0%. So they're going to throw all their money in the stock market. Yes. So from a simple supply and demand perspective, you have the stock market then rallying, asset prices going up, real estate prices going up, which is, again, just going to funnel more money to the rich and wealthy. So even though maybe the offset of the rich and wealthy spending their money instead of saving it, they also are going to benefit from the asset price inflation. So again, this is why government pulling strings, no matter what, messes things up. The fact we are talking about this right now, the fact we've talked about the Fed for 4.5, 5 years, honestly, I'll be completely honest. When I was graduating high school, or college, I never thought about the Federal Reserve. The Federal Reserve was not really anything anyone ever talked about because it wasn't that involved. But then 2020 happened, and the Federal Reserve was talked about every single day. It just shows you how much the government, the Fed system, is in our pocketbooks, dictating supply and demand in the economy. It's meant for two things: bailing things out and breaking things. And it just screws things up even more over the long term. So how do you position? In my opinion, I don't think we're going negative anytime soon. But again, I think we are going lower when it comes to the interest rates because we have to, literally have to, which is why, again, I've been so prominent on those longer duration stocks, utilities, long duration bonds. It's very interesting. Bonds yields were up this morning. Now they're actually down. So I think the risk off trade is coming on again. So I think that's the spot to be. Right. When the market's down 1%, my goal is for my clients to be down barely anything, right?
Well, you know what? We got to jump, but I'll leave you with this, as I'm a lot older than you are, Luke. And I can tell you there was a day in this business where the Fed wasn't involved like they are today. They weren't in your back pocket like they are today. We've always talked about normalization pretty much since 2008, 2009. That's when the Fed really dove in. But there was a day back when they played fair with Alan Greenspan around, and it wasn't anywhere near the shenanigans that we got going on now. So hopefully we get back there one day, but I appreciate it. Thank you very much, Luke. Have a great weekend. Luke Lloyd coming